very much. Okay, hello everybody. I will share the screen. Before we will start, I have a proposition that if you will have some questions during my course, during my journey through the algorithmic trading and through our approach, so guys, please ask questions and we can interrupt anytime and we can discuss something regarding this topic that I explained. And basically, so it's actually it's not so convenient like it was 1 and 2 years ago when I organized some algorithmic trading meetups in Kiev. So it's online format and it's not so convenient, but I think it will be also. I hope it will be also fine. So please make it live as much as possible, and you're welcome to ask any questions and to add something from your experience or from your project or something else. I will little bit introduce about myself and about project. So during this today's event, I will share results and speak about our project AlphaCube. And I will be focused not to make it like marketing, but I would like to focus it from the interesting side and make it useful as possible to all of you. I know that people who come here today, some of them machine learning engineers, developers, algo trading, the guys who are interested in algorithmic trading, maybe somebody from a business industry, from investments. So everybody welcome, and I would like to make it useful. So I will explain what we're doing in our project, and I will try to make some takeaways and explain why we did so, and give examples and give some recommendations from my side and from our experience. So the topic is alpha mining. So alpha mining is so you probably, if you comes from machine learning industry, so you know that data mining is very huge sphere of machine learning. And today we will speak about alpha mining. So this is a process when you can generate different ideas, different scenarios, strategies for algorithmic trading. And I actually started my journey 12 years ago. I started just by development with my own strategies, my own ideas. I tried to collaborate with different businesses, with hedge funds, with banks, with different traders. They just asked me to develop some strategies because I was developer. I'm developer as well now as well. I have mathematical background. So I switched to algorithmic trading. I started with development some simple strategies, and then I realized that if I will be engaged in investments, so it should be all will be automated. And for the 5 years, I realized that there are a lot in common in different strategies, and I have an idea how to automate even creation of these strategies. And today we will discuss this approach. I think this approach have a lot of benefits in comparison with other classical approaches, and I will explain why, and also will compare some things regarding it. Also, today's event will be recorded, and you will receive recording by email, I think. So, as George Soros told, the markets generally are unpredictable. So that's why you need always different scenarios. So markets goes by different scenarios, and as well, you need to cover all these different scenarios. And if you will just create one single strategy or just trade by some specific idea manually, so probably it will be not good. So probably you need to have a bucket, you need portfolio, you need a huge amount of strategies with different logic, on different time frames, with different approaches, and then combine them in the portfolio. And sure, you need to be flexible to enable some strategies, to disable some strategies, because you need to cover all possible scenarios. I would like to start with my vision of market efficiency, because everybody speaking about that market is efficient, the other guys speaking that, oh, no, market is not efficient. And I think the truth is in the middle. And I think the efficiency of market is actually growing, continuously growing. If you will compare current market with 90s, you will see that right now trends are not so smooth, are not so nice. So there are a lot of market noise, and sometimes volatility decreasing, and it looks like flat, that you can do nothing with it. So if we're speaking about efficiency, so I think definitely market is not efficient. Definitely efficiency is growing continuously. And this blue curve, this is how I see as the current markets, current opportunities in the world for all humanity. For example, right now in the world, some population. Right now we have some computation power with personal computer, with laptops, with cloud computing, and so on. So if we will combine everything and make it as smart as possible, so we will see we will have this efficiency right here. But actual efficiency, the actual market efficiency, is lower than maximum possible. Why? Because here I just mentioned few general ideas. Not investors are different market participants, and investors have access to different information and different ability to process it. Then technological possibilities is absolutely different, because somebody have only laptop and mobile, somebody have access to cluster computation engine, and so on. So it's not equality in the world regarding this. Then human psychology and emotions take a very important place. You can sure about it just looking on the Bitcoin price, because it sometimes it clearly demonstrates some euphoric, some solid strengths of the positiveness, and some periods when everybody sad and don't want to do anything and just selling and selling. So because of this fear of missing out, FOMO, so-called FOMO, because of it really exists. So this gives opportunity to little bit multiply and make some pumps on the markets, on S&P 500, on gold, on cryptocurrency markets. It's huge pumps on this market. So that's if we have such psychological events. So that's why this is not true price of the current asset. So that's why we can trade on it, and we can predict the fair price and trade against it, or otherwise we can trade during this trend, during this continuation of it. So that's why actually market is not efficient. And also, so I see that right now we have, let's say, humanity actually sometimes following some not very logical trends. For example, COVID-19. So you see a lot of, even when everybody realizes that there is not so dangerous, so masks are still using in many countries. And I know few examples in the world that even when the numbers of the cases of COVID-19 was very low, they are still continue using PCR tests and masks and have a lot of restrictions. And we can say that this trend is absolutely great. Yes, this is some logical logical mistake of all humanity. Sometimes, for example, I came to one website and register on it, and this website asking me, what is your gender? And I have something like 5 options: male, female, binary, I don't know, and so on. So it's a madness. And sometimes humanity makes not correct things globally in the world. So that's why the market as well have some efficiency problem, because humanity can see the future. We can see, we can create a prediction what will happen if we will not use all the masks regarding COVID-19, what will be in the 1 month and 2 months. We can predict some portions of it, but the risk of error too high. That's why humanity always following some trends, some logical events, and making mistakes. And based on these mistakes, we have a market inefficiency. And let's say somebody created an algorithm that can, like a vacuum cleaner, look for all inefficiencies, pick up all the strategies. So in this case, this event can increase the market efficiency. And I think based on history of markets, I think that we have curved something like this. So market efficiency, sometimes it's on a flat waiting, and then we have a boost, and we hit in the maximum possible market efficiency. So that's why all the time market will exist, and till we not in this place, we have every time opportunity to use algorithmic trading. And but this is just a question, what approaches of algorithmic trading to select. And I think that today we will discuss some new approach that 5 years ago it was absolutely wild and ridiculous. When I told about this idea to some professionals and somebody from investment industry, they told, "Oh my God, it's so difficult. It's absolutely nonsense." So this is actually interesting slide about problems that actually we currently we have on the market. This slide is very interesting because it's the text of it completely generated from the ChatGPT engine. So probably you heard about it, maybe used even. So this engine you can access online, and you can ask some questions. And I think it was questions something like, what is the problems of algorithmic trading, or what is the problems to be successful on it? And actually all these texts are generated from this engine. I actually placed this slide here with those texts because for me it was very powerful event when AlphaGo algorithm was developed. So this is algorithm for playing Go game. This is like Japanese chess. It's the game when you use black and white tiles, and you need to surround the opponent's tiles. And this is a very interesting game because there are a lot of different combinations of moves. And in chess, it's less difficult to pre-calculate and to have some patterns. In Go, it's more difficult. But AlphaGo developed such algorithm, and it was successful. And I think 5 or 6 years ago, AlphaGo conquered the world. I mean, the best player, it was AlphaGo. And what is interesting that people actually teach this algorithm how to play, because this algorithm looks through all the professional games and learn from it how to play. And then this algorithm start winning the other professional players, and it becomes #1. And then people start learning from the algorithm. And this is the most interesting part. Actually, in our team, we have right now 9 guys in our team, in AlphaCube team. Actually, we have all analytical department. And our analyst, we perform different analysis, how to combine machine learning and how to optimization techniques, and how to combine with manual selection of the strategies. And after few experiments, we realized that the best result we can achieve only when a professional trader pick up the best strategies. And after this, we applied the algorithm for optimizing it. So I think the in general, in algorithmic way, it's important to everybody, to all of us, that we need to look on the picture from the high point, like helicopter view. Because if we will go deep to the mathematics or development, it will be a problem. Or if we will just create some simple strategies, it will be also a problem. And one of the why is algorithmic trading actually so difficult? Yes, definitely, it's one of the difficultest tasks in the world, because we're trying to predict the future of the assets in short term or in long term. But other problems that we have right now in the algorithmic trading industry, that it is very difficult to enter this market, because you need to have some technique or some components or some strategies that will be better than other market participants. You should be better, like in a little bit than typical, than common market participant, because the market is actually it is war, and you need, if you win, somebody lose. But it's actually not a problem, because sometimes people need to make some transactions fast, or they, for example, need more or less liquidity, or because of psychological events, or they need to cover some expenses of company. So in this case, they come to market, sell or buy some assets, and you, for example, if you are making arbitrage or market making, so you can earn on this inefficiency, because somebody needs quick and you can wait and make on it. But still, algorithmic trading is a very difficult part, because you need to cover a lot of different parts of it. You need to be a developer, you need to be a mathematician, statistician, and so on. And for example, in 90s, I just went to school on 90s, but I read a few books about how actually quantitative industry, how it's starting with, and it was actually very difficult for professionals to go to this industry and to start or operating with different companies, with different hedge funds, because they need to cover everything. They need to somehow fetch the data, somehow store it, then somehow calculate some ideas, then make it absolutely not something manually, some wrote programs from the scratch, and so on. So right now it's not so a problem. So you have a lot of tools from making prototypes, and also right now you can Python, very powerful engine, and you have a lot of libraries. And I started using such libraries, such tools, I think 12 years ago. And then in few years, I realized that I don't have so much flexibility. And this is actually AlphaCube how it was created. And because in AlphaCube right now we have a lot of different tool sets. Okay, let's go next. It was problems, but let's speak about different approaches that using for trading on financial markets. So first of all, simplest idea how you can invest money. You can use positional trading. Just buy and hold, buy Bitcoin, buy S&P 500, buy some stocks and hold. Then company or trader evolves and thinking about additional manual trading to perform some additional open some long positions, short positions. And so right now we have in world a lot of prop trading companies. They are looking for smart traders. They picking up best of them and combining the portfolio from them. The next step is algorithmic trading company. So probably you here are experienced with this step, and so probably you developed some bots, and this is definitely the next step. This step actually it produces a lot of issues like overfitting, like big data processing, and storing all the such data, and then handling all the errors. When you just make some optimization of your system, then the company or you as individual thinking about how to make it more efficient. And then we speaking about machine learning. And actually, to be honest, I know a lot of different machine learning companies, but they are not, to be honest, so successful. So machine learning in algorithmic trading not equals success. And I think that one of the most main issue that machine learning in general, common uses technique generalizations, different generalization techniques for eliminating overfitting. So you just picking up something average from all the data. And if you pick up something average that on historical data looks like works, so you decided that this strategy will work for some period of time. And also, there are a lot of companies that are absolutely fall in love in some specific machine learning techniques and trying to solve mathematical problems using it to make it efficient. And what actually we are doing, I can't say that this is better than something that we discussed before, but we actually generating new strategies. So we're not optimizing strategies, we optimizing them as well, or optimizing portfolios. But we generating new ideas, new scenarios, new strategies, and making it based on just brute force, using genetic algorithms, using gradient boosting technique, and also we also generating strategies based on labeling. About these things we will discuss a little bit later, but this is just overview for you that I can't combine together machine learning techniques with AI mining or alpha mining technique, as I told. Both of these directions have pros and cons, but I think the mining gives more power and more flexibility. So right now we have, it's possible for us right now, we're generating 40 million different strategies per day on single server. The key feature that provides this opportunity for us is that we have pre-calculated data. If you will interested and you would like to go to the optimization and make it as powerful as possible, or maybe you would like to make even alpha mining, so I definitely recommend you to make pre-calculation of different indicators, of different filters, so everything that you will use in the optimization. So it's better to pre-calculate, because if you will calculate on the fly, it will take too much time, even if your engine very fast. But if you will pre-calculate everything, in this case, you can just pick up necessary data from the storage, from the database, or from flat files, let's say, or from some service like by the REST API. And then you will fetch this data, and then based on this, upload it to the memory, and then make calculation as fast as possible. So this is only one possible way, I think, to achieve very high speed of calculation. I will not keep too long on the slide. Just I will explain a little bit in general what is the features we have. So we have variability to different with different components and with different analyzers. So we used only technical analysis right now. I have an idea to connect as well some fundamental metrics. So actually all our system based on are so-called filters. So you have some metric, you have some indicator, you have some just mathematical equations that just saying you true or false. Right now, is it Is it mine? Is it Thursday right today? Yes, true. Is it, for example, is it moving average 10 is above the moving average 5? True, and so on. So every even neural networks, even some machine learning models can just you give a response true or false. And we called such components, we called them filters. And actually we have a lot of them. We have 300 different indicators, filters, different components that are using in our strategies. And then we generating from them different combination of them. And very important thing is when you create strategies, make it diversified as possible. But you need to keep in mind that very high diversification kills the profit. So it should be some middle point. So simplest way what you can achieve, it's use Markowitz theory. You can use just a tangency portfolio and optimize your portfolio by Sharpe ratio. So for example, you have 10 strategies in your portfolio, and what you need to do is to optimize this portfolio to make Sharpe higher as possible, because each strategy can have different weight, and you can optimize this value. And as a result, you will have some strategies will cover other strategies and diversify. And for example, one strategy winning at this time, the other strategy will hedging and will cover some losses. But if you create too much diversified portfolio, it will be significantly decrease as well profitability. So I prefer to optimize it by Sharpe ratio, or find the portfolios little bit go into the more profitable side if when you go into the tangents line, if you're familiar with Markowitz theory. Okay, so we trying actually to combine different industries. We combine in mathematics, we combine in machine learning, we combine in our team traders experience. And the other very important thing, we're trying to eliminate overfitting. About overfitting, we will speak a little bit later. It's absolutely important for all of you to think about what is your goals when you start in some business or starting just creating the strategies, because you need to exactly know you would like to trade on some small amount, so you can make some, let's say, triangular arbitrage. In this case, you can maybe sometimes it's very efficient, but only on small amount of money. Or for example, you would like to scale your strategies will be low frequency, and it means that and you focusing on the conservative portfolio, so it will be stable, consistent, smooth, but it will be you will feel the results on the long run after 1-2 years, only after long period of time. Because for example, sometimes for business or for your personal need, it is important to make other strategies. So before you start developing some strategies or alpha mining, you need to exactly specify what the goals you have. And for our company goals, we have low frequency trading. So we are focusing on smart strategies, not quick. Because if you would like to go inside arbitrage, if you would like to go to the HFT, so definitely your stack should be different. So technological stack, I mean. So probably you should know C++. You need to know how to FPG to upload your code to FPGA, and you need to think about low latency. You need to think how to find the data center with low latency, and so on. I'm not engaged in this business, so I can't tell you much about it. We are actually focusing on low frequency trading, so we're trying to build smart strategies that can predict future with, let's say, 57 percent accuracy. So it's not 50-50, it's a little bit better. So this is our target, and what we are focusing on. And sure, you need to find markets that are better for you. As right now, we're working on crypto, and crypto is a pretty good market because it's very volatile. And it's actually, you have instruments with very good liquidity. On Binance, for example, on DivideX, on other exchanges as well, you can find very good liquidity. And you need to, before you start making strategies, the good idea is to calculate like benchmarks. So what is the possible profit you can make? So what is the volatility of instrument? What is the liquidity? What is the typical movements? How much percentage? How much time you have flat? How much time you have trends in percentage? What is the cycles? So you need to consider that maybe you will fall in some cycle with absolutely low volatility for a long period of time, for 1 year, for example, like right now on the crypto. So yesterday it was pretty big volatile movement, but before it was very low volatility. And this is an issue for a lot of different strategies. So please keep in mind also selecting the correct instrument and analyzing them before start trading. Also, you should check the spreads. You should check the trading fees. On some markets, you have funding rates. So funding it when you open position and you need to pay or exchange paying for you for some small amounts of your open position size regarding the side. For long, it could be positive, for short, it could be negative, or vice versa. So you need to check funding rates, you need to check swaps. And typically funding rate at swaps are very small, but you need to also consider if, for example, if you would like to trade with very volatile strategies, with very risky, with high multiplier. So definitely you need to check the margin requirements, and funding rates as well could impact a little bit on your trading. Also, it's better if you can combine different principles of trading strategies: trend following, mean reversion, range trading. So if you can combine different strategies, it's better. And if you can generate them automatically, it's also better. So try automate as much as possible. If we will coming back to the idea of AlphaCube, so actually it began from idea that all strategy algorithms have a lot of much of the same. So all strategies using some indicators, some filters, making some calculations, and actually input always the same data and strategy settings, and the output also every time it's the same trade actions and trading log. So based on this approach, actually, we built trade engine. This is one of the service in our technologies that we are using them. If we're speaking about the components, so I definitely can recommend you cover different types of analysis. So right now we're using, in general, it's indicators. We're using pattern analysis, like graphical analysis. And also we use a lot of different custom investigations, research. And when we make some research, we realize that, okay, this formula or this pattern can work better than some classical indicator, for example. Definitely, you need to use digitization and smoothing. I mean that, for example, just simple moving average, it's not a good idea to trade directly on using them, but you can use moving average to apply it for some other indicator, for some specific data, and you will have smoothed data. And based on the smooth data, it will be easier to detect trends to some some spikes and so on. And it's a good idea if your system will be flexible, so you can apply one indicator to other indicator. If your system will be flexible in case of adding new indicators. So don't write code very dependent. So you need to have dependency system. You need to, or you need the dependency system, or you need to design all components absolutely independent. So I definitely recommend to spend some time to understand what actually components you would like to use, design it, and then after such designing, implement such components. Definitely, it's very important to understand trend and different market conditions. It's based on our experience, it's impossible to generalize it. I mean that answer right now is uptrend and point. It's not possible, but different strategies can operate on different in different market conditions. So that's why you should have different trend filters, volatility filters, but you need to adjust such filters for different strategies, because there is no universal filter at all. Also interesting thing is VSA analysis, volume spread analysis. And I think that's all. The other, it's pretty typical and pretty it's classical indicators. If you would like to deep a little bit about, think about what classical technical analysis better to pick up, I definitely can recommend book from Perry Kaufman about trading strategies. On the end of the slides, I have list of books, courses, and other materials. I will share it with you. Okay, let's deep a little bit about our backtester, and I would like to share our approach, how we backtesting strategies, how we building strategies, because typically when you use such classical trading engines, some frameworks, typically you need to write a code to run a strategy. I mean that you need to, for example, on TradingView, you need to create a strategy in PineScript and connect it. In MetaTrader, you need to write code in MQL, in Deltix, and so on. So all frameworks based on it. There are other options. For example, some TS Lab provides possibility to make a visual creation of strategies. But our idea is to make strategies very flexible for machine learning, for mining. Our idea is to make strategies in JSON format and make the blocks of the different components, different indicators and filters. And the idea is to then, when you define some specific component, you can use this component in your formula, and then your formula will be very simple. So like here we have few examples. You can with a logical AND combine high volatility and uptrend, let's say, or you can just add logical NOT and make absolutely vice versa. To your filter will work in absolutely other side. And you can combine these bracelets and with other logical operators, what you want. So actually, this approach very easy for human, and it's very easy for machine to generate such formulas. And then, later in the slides, I will show you examples how our technology can generate such strategies. So my recommendation here is to, if you use some framework, you need to make your strategy divided by different blocks. So, for example, you write all single strategy in Pine script or in other framework. You need to divide it on blocks and specify parameters for each of block. Only in this case, you will have the opportunity to optimize it and to make it better, and maybe to even to disable some blocks of it. Sure, it's better if you can use some framework that gives you opportunity to mine the strategies. And also, right now we're working with different companies, with different businesses. We right now cooperating with few hedge funds, and right now we have a great partner in Italy, and we're going with him to the decentralized world. But to be honest, we are open to collaboration, and if you have ideas to build something, so please let me know. We are open, and we have this trade engine that I'm sharing right now with you. We have some version of it that even we can share with anybody. So for example, you can build your own components on some trade engine wrapper. So it's separate service that could be used. It will connect it with our proprietary trade engine, and you can even build strategies using such formulas. This is one option. And second option, sure, I definitely recommend you when you using any framework to separate each component as much as possible and make a possibility to optimize it and to then make some data mining to create different strategies using such blocks. This is just an example of a JSON file that we're using. Here you can see the absolutely big formula for open position signal. And in our strategies, we can specify, in our JSON format, we can specify all even actions that will be, it's like scenarios to handle positions like break-evens, like trailings. And then you have a section where you can define different indicators, different filters, and then give them some names. And then these names you can use in the open for close formula to combine them in the more difficult logic. If we're speaking about all process that algo trader should come from idea and to launching, and what amount of services and software you need to establish such a process, I think we can go through some key services that definitely you need. So in our terminology, trade engine, this is a service that performs the backtests and could be launched in the live trading. So this service receives the strategy, reading strategies from the file, for example, and then operating with it. Then we have separate service. It's called data manager. So this service knows everything about market data, about pre-calculated indicators, filters, and so on. So we have centralized data storage. We have actually some issues with pre-calculating huge amount of data, because even when you accessing it via API, so you have some additional latency. You need to send some request, receive response, handle it. So it takes additional time. For example, for when we using high-speed calculations, in this case, we're using only flat files. So we're not using additional service for it. But I definitely can recommend you to establish some data manager, some additional server, some additional entities that will know all data that you're using for different exchanges and for different analytical components that are using in your strategies. This will give you a lot of flexibility in the future. Sure, data mining can use as well this storage, and then data mining, alpha mining can generate some strategies. Definitely you need a visualizer. So your framework should gives you possibility to visualize your trades, see the pre-calculated data, and for example, I can recommend use trading view. You can ask on the website of TradingView. It is place when you can download TradingView library, and there are two possible options to use TradingView on your own web server. So you can use just visualization library, or you can even use advanced library. I don't remember the proper name of it, but we're using it. And we have license with TradingView, and so we set up this TradingView library instance on our own server, and we're using it for our customers for public usage. So anybody can access our server and see how it works. But additionally, we use this TradingView instance for visualization of our data. So we can visualize our indicators, our filters, our labeling, and so on. This is very important because you always need to check what you did. Is it correct? And for example, you build strategies, you need to see how they trade in visual way. So that's why you need good visualization technique for it. Then it's good to make a focus on develop different trading and investment metrics, because definitely you need to check all of them, not all of them, but pick up the best and evaluate your strategies based on them. Later, I will give you a list of investment metrics that we are using. Then you will have some execution software that will connect with trading accounts and deliver signals from your engine to the exchange. Additionally, probably it's better to use additional risk manager system that will be separated. If something happened on the exchange, this risk manager will violate and close your positions, for example, or disconnect your account. And should definitely you need to have a monitoring service that will give you errors or some disbalances if something occurred. I can recommend you never use loops for sending the orders. Sure, definitely. Sometimes you need to use loop for send 2-3 orders or split it by some chunks and then send it. But you always need to check your code for the possible endless loop. If it's a chance that you can receive from the exchange some wrong information, and based on this wrong information, you will have endless loop. So probably in a few minutes, you will realize that all assets are completely invested in some specific asset because you have such loop. And this is a not so bad scenario. The worst scenario, it could be even when you open and close position continuously. This is absolutely dangerous because you will lose all your money very, very soon. So keep in mind that this bridge or connector that will be connected to the exchange should be very secure in this case for the endless loops, and you need to keep in mind this. So I a little bit switching to the practical side. I will share about our results, what we have right now, and how we achieve them. And I will go a little bit deeper in alpha mining approach. So current portfolio that we have right now, it's backtest data, but we continuously update our portfolio, and this is our current portfolio that we have. It have 144% since 2018. This is 31% annualized return. It's not so high, and probably you know that guys that are interested in crypto, they are looking for high volatile trading instruments, and that's why actually so low returns in crypto sphere, it's not very interesting. That's why, but if you achieve low drawdowns, and if you have very good curve, very smooth, in this case you can think about using multipliers. And for example, you can multiply position size by 2 or by 3 and scale it. This portfolio that you see, it's combined with, so we generate about 100 million different strategies and then pick up 21 best. And so when we calculate in different strategies, we perform in different metrics. Such metrics I will give you a little bit later. But as a result, we have this portfolio, and even this year, it gave pretty good results in comparison with market crash and market movement down. This is how we see after generating the strategies, we're picking up the best strategies. And one of the simple but pretty efficient way to pick up the best strategies, this is a Sharpe ratio. Definitely you need to consider how much trades positions you have. You see, I have experience with communicating and with working with some algo traders that are thinking about the big amount of positions, and it's actually a very dangerous approach when you I'm sorry, it's not dangerous, but it's risky because you removing all the strategies that have low amount of positions, and you looking only for the strategies with absolutely huge amount of positions. They are very rare, and your diversification will be struggle because it's better in algorithmic trading. It's better to detect the middle point and find something between. Sure, you need to remove the strategies that have on very low amount of trades, but you don't need to focus in only on strategies that have absolutely huge amount of trades. So typically, the flexible approach is better when you can perform different analysis, different experiments, and see what you can extract from the market and from your engine. And if you see that you can extract, let's say, maximum 1,000 positions from your strategy, so probably you need to filter by 100, by 200, like you see on this chart. This is one of the best strategies that we generated. And you see the annualized performance of them is from 20% to maximum 54% annualized return. So from our opinion, and from experience of our team, it's pretty good. Regarding drawdowns, sure, it's as less as possible is better, but you need also to keep in mind that you need to pick up only strategies with absolutely small drawdowns. So when you will build a portfolio, you will combine different strategies by Markowitz theory or by other approaches, and in this case, you will have for your final drawdown will be less. This is just a distribution chart where I can show you the correlation between Sharpe ratio and net PNL, and definitely this sector, this cluster, right and upper side, it's better to pick up. So we typically discard strategies that have Sharpe ratio 1 or less. Also, we discarding strategies that have default average annualized profitability 30% or less. Because you need to keep in mind always that, let's say, if you have results 31% in live on backtest, definitely in live you will have worse results, so probably 25, 27, but it's very dependent on how you eliminating overfitting. Okay, let's slightly switch to the stress testing. So let's say you can generate different strategies, or optimize your strategies with different approaches. And one of the case how you can understand is your strategies or portfolio stable or not, you can test it on the other trading instrument. So for example, one of the such of examples, this is the best curve, this is original portfolio, and when we just switch it to the another instrument, we see that results are are not so good. And even one instrument, XMR, it demonstrates results near the zero. So what I can say regarding these results, so if you have strong negative results after applying such experiments, you need to discard your strategies or portfolios that you have. If you have a decreasing of the profitability, that's normal, because your strategies are adapted to the specific instrument or specific market, and that's why when you changing the instrument on market, definitely it will demonstrate other results. But if you have a good strategy, results should be positive, and as well as the behavior of curves, it should be also be pretty good. This is example of two strategies. This is actually the magic of alpha mining, that you can generate a lot of different strategies, and then even you can pick up two strategies that have very low correlation between each other. And this is example of two strategies, and as you can see, both of them two of them are winning. They generate pretty good profit during the four years. And the important thing here is that when this strategy go down, this go up. And it's very, not always, but it's very often that we see that these two strategies are hedging each other. And the trick that you need to put in your portfolio as much of such strategies as possible. The good idea is that connected with alpha mining approach, that you can even prove it, and you can even make a walk forward test. But for walk forward testing in classical way, it means that you re-optimizing the strategies for different time moments. But with alpha mining approach, you can go to the next level, and even you can generate strategies portfolio for some time moment. Let's say for January 2020, then you can with this generated portfolio, you can go to the next point, and you can calculate what it will be performance on this for this month, and then you can regenerate new portfolio for this let's say 1st February 2020, and then continue this experiment for the next month. So as a result, you will have the final walk forward test of not just the final portfolio, but you will have simulation how you will adapt to the market conditions, how you will adapt to the market changing, and you will be sure about is it your approach working or not. Okay, let's think a little bit more about overfitting. Sure, all of you know about what it is. Just a few words about in general. So this is the main problem of algorithmic trading globally, because when you creating some strategies in any way, you checking it on historical data, and you have a big chance that when you creating some strategy, the strategy will be very fitted to the historical data. And in this case, when you will switch your strategy to the live market, there is no guarantee that the strategy will generate profit for you. So that's why you need to, you should build strategies based on some logic. If you optimizing strategies, if you making alpha mining, you need to be sure that components that you are using are pretty stable and they have some logic, some traders logic. This is one approach. The second approach, that you need to evaluate your strategies by different investment metrics and with different stress tests. What is good with alpha mining? With alpha mining, good that you can calculate different metrics in sample and then out of sample, and then compare them. And then you can check different approaches, different experiments, different labelings, and you can understand what is the overfitting ratio for one experiment and for other experiment. And based on this, you can pick up the best approach. So alpha mining is not just, you see, it's not just 1, 2, 3, some algorithm that you can just apply and so on. This is actually, it's a tree of different approaches. And right now, we only 2 months ago, we built our first version, finally. We built the first version that can generate strategies. And we even built a portfolio on it. But we see a lot of huge possibilities and a huge also problems that we face it with, and we need to consider how to go next to the next steps. And what is just questions that we have right now? First question is how long should be formula? Because when we use more longer formulas with more logical components, the strategies becomes more overfitted. Less shorter formulas, less overfitted, but they have not so good performance. So we need to consider something in the middle. Then regarding generating of strategies, we can generate just strategies with gradient boosting and with genetic algorithm with some improvements, and just compare the strategies with, let's say, some fitness function, let's say, with that could be based on net profit of drawdown, on Sharpe ratio, Sortino, Kalmar ratios, and we can make some ensemble formula based on such metrics. But then we realize that this approach is not actually very efficient, and more efficient approach is when you creating a labeling. So under labeling, I mean that you have a chart. You label this chart with some specific data, like you highlighting the uptrends, downtrends, volatility, high volatility, low volatility, some other patterns. So you put the marks on the chart, and this mark then will be used by algorithm to build predictors. So, for example, you highlight on the market uptrend, and then you're building the predictor that will predict this uptrend. And as a result, you can have a strategy because your predictor could be used for the open position signal. And in this case, you will know that when you open this position, you have 57 probability that this uptrend will be a little bit have a continuation, and you have a chance to close the position with take profit, or close it by other condition. So I mean that to generalize, so alpha mining, it's not something simple. It's actually a big tree of different ways how to go. And right now we are in the situation where we have good results based on the alpha mining approach, but then we have a lot of different experiments that we will perform to understand what actually alpha mining approach, what is the modification of it, what if will work better. And then just imagine if you don't have such alpha mining technique, if you just making strategies just in manual way, so it can't even be compared with alpha mining, because alpha mining can generate 40 million strategies per day. And imagine you can, for example, with our analytical team, we building strategies with algorithm, and as well we making strategies in manual way. I mean that we have analytical team and developers team that also develop such strategies, but the speed of creating such strategies is very low. So for example, we can create 100 strategies in 4 months. It's normal for the manual creation. But just imagine if, for example, if even with alpha mining, we have a lot of questions. So just imagine that if you creating strategies in manual way, so it's other level of complexity. And in this case, you don't see the picture about the overfitting, you don't see the picture about profitability, you don't know about even statistical some probability of creating the profitable strategy. And metrics that you are using probably also overfitted. Only performing a lot of different experiments, you can see the full picture. And that's why I'm very recommend to use such approach, or some of combinations that will lead you to see the whole picture of possibly generated strategies and possible optimizations of them. And let's come back to overfitting. And one of the main issue of classical machine learning, for example, if you use some approach, let's call it bagging. Bagging approach explained very well in the DePrada book, Advanced Techniques in I will share this book, the name of book later. But this approach, bagging, it's actually finding the general solution. So this idea is when you have machine learning model and you teach and you have you split your data on specific bags by specific criteria, by time or by something else, maybe even by some features. And then when you calculating the model, you're creating the model for different bags. And then as a result, you're creating the superposition of these models, you're combining them together. So this is actually one of the possible way to eliminate overfitting. It's called regularization, or finding the general solution. But this is actually, we have this issue in our current portfolio. It's not issue, it's characteristic of it. But you always need to keep in mind this characteristic, that, for example, if you will teach the strategy on the last 4 years, and the strategists will understand, no, not understand, sure, they will adapt to the market, and they will find the patterns on high volatility, and they will trade on high volatile market and make a profit on the high volatility. So then when the strategy switched to the low volatility, this strategy will be in trouble, because this strategy can't generate any profit more. And yes, your portfolio great, you can generate profit in the long run, but you need to keep in mind that this general solution could be an issue in short period of time. So that's why you should keep in mind other overfitting elimination techniques, like using larger training set, because if you have a small period of data, you have an issue of overfitting. If you have larger, the probability is less, but still this this problem have the same issues like general regularization. So this is not protecting you from the receiving good performance in the future. And only third solution, only improving quality of model really can save your portfolio and make it really profitable. but not like based on regularization. One of our colleague told me 1 week ago that he told me, Bogdan, it looks like our portfolio trading like he's plays in poker. So he tried to calculate the probabilities, trying to make some decisions not so obvious, but sure, it's based on the probability calculation. So if you making using only 1 and 2 approaches with building your portfolio and building your strategies, so definitely will have such issues. And that's why you need to also understand quality of your model. And what we actually doing, we making a different stress testing. So we analyze how our strategies operates on different market conditions, up movements, down movements. We performing Monte Carlo stress testing, changing the settings of the strategies to understand is it stable or not. Monte Carlo stress testing, it's like shaking the ladder. So when you would like to go by ladder, so probably you need to use it and then shake it to check is it stable or not. If it's stable, so you can go ahead. If not, so probably you do not need to do it. And so the same with Monte Carlo stress testing. So you need to check the stability of your strategy. And also you need to use solid and verified trading components in your strategies, because if you will just using technical indicators, it also could be an issue. So it's better to use patterns, graphical patterns, candlesticks. So it's better to use as well as a combination of technical patterns, combination of technical indicators. So for example, if you will just use one indicator, it's good, but if you will use combination of them, it's better. As well as if you will use the same indicator but with some indexes of sets, like you will compare the value of indicator for current bar and with previous bar and the second bar and third bar and so on. In this case, by comparing such bars, you will discover some kind of pattern, some kind of graphical pattern. And this pattern will definitely works better than just comparing moving averages or just comparing two indicators each other. What actually methods I can definitely recommend for the strategies validation to remove the overfitting and to improve the efficiency of strategies? It's different stress tests on different markets. In sample and out of sample testing, it's simple, but you definitely need to do it. And also, I can suggest you read from the Perry Kaufman book about some interesting approach about checking in sample and out of sample. This approach is idea of it that you can split all the time series on small pieces, like 1 day. And then you, for example, all even days, it's in sample, all odds days, it's out of sample. So you split all the time series in this way. And then when you calculate your PNL curve, you can, this PNL curve also cut by in sample and out of sample pieces. And then you can understand what is the comparison with in sample and out of sample results. Sure, definitely when you optimize or when you perform alpha mining, definitely you need to optimize something only in sample and then check it for out of sample. And definitely one very important approach you need to keep in mind always, if you receive something, if you receive out of sample results and this result is bad, so you definitely need to discard the strategy immediately, because if you will improve in sample, so out of sample also will be better. In this case, you are cheating. And in this case, you just removing the probabilities that your strategy will generate profit in the future. So that's why please be careful with in sample and out of sample tests. Monte Carlo stress testing, it's could be done in different ways. We use it to shake the strategies, to change the settings and evaluating them. Also, good idea is to check correlation between strategies. So definitely when you launch your strategies live or before launching live, you need to check how it's operating good even after discovery. If it's still good, fine, you can use it. If it becomes bad, probably something overfitted, just discard it. As well, you can calculate the correlation between live market data and backtest data. And you can calculate even correlation between separate trades. So let's say you open position, and after opening position, price goes to your direction, and you have profit, and you can have a P&L distribution chart for each separate trade, and you can compare them together. So you can calculate correlation between them. You can calculate the average correlation for the backtest, and then you can calculate average correlation in live. And also you can compare backtest and live. And if correlation, you don't have correlation between backtest and live, so probably or market changed and your strategy didn't work, or you trade some other patterns that you're expecting. And in this case, if you found this issue, you have a chance to disable it as soon as possible. So actually what I am right now mentioned in this list, some of them we are using and some of them we are practicing even right now, but some of metrics I used previously and I have good experience with such of metrics, and definitely a lot of things we need to do. As I told you that alpha mining, this is just an open a door, and it gives just instrument to perform a lot of experiments and improve your strategies and improve your portfolio. Okay, the next metric is, the next idea is to use different investment metrics and scoring system. Under scoring system, I mean ensemble model that you can create a fitness function that will be consist from different investment metrics. Definitely, I can recommend Sharpe ratio, Sortino, and Kalmar ratio. Kalmar ratio, very interesting to understanding drawdowns. And this is a ratio absolutely important for the alpha mining, because you see, when you generate different strategies and such strategies are very bad performing for some period of time, or even for last 3-4 months, this is a issue, this is a problem, and you need to discard the strategy. But imagine that you will check the best strategies all the time in manual way. It's impossible. So you need to check such strategies in automatic way, and Kalmar ratio can help you with this, because he will give you low value if your strategy have significant drawdowns. So even Sharpe ratio sometimes didn't show you so good understanding like Kalmar ratio. So I definitely recommend you Sharpe ratio use, Kalmar ratio use, maybe Sortino as well. Alpha beta coefficients, this is to understand how you performing against market. Is you better or market or not? Definitely you need to consider drawdowns, because drawdowns are explaining what the volatility you have, and volatility is equal risk. Please keep in mind always that algorithmic trading, that financial markets, it's not normal distribution. It's like Cauchy distributed time series. And so you have always a chance of black swan. I mean that if you calculate it, oh, everything fine, I have only 0.01% risk. So probably in life, it will be higher than your calculation because of overfitting and because of Cauchy distribution and because of the black swans exists. And so please protect your portfolio additionally. So for example, our portfolio have maximum drawdown 6%.
based on our simulations, stress testing, and so on. But we always saying that our portfolio have 20% maximum drawdown, and we called it technical analytical drawdown. So it's we in analytical way realize that it exists some combination of events. If even our portfolio will demonstrate some bad performance when market will change, for example. So you need to also be very careful with drawdowns and try to minimize maximum drawdown, and also good metric is average drawdown. Very good to understand and to optimize recovery time, because recovery times gives you understanding for how long will be possible drawdowns in a time. And this is very important metric for the investors, for the customers, for the hedge funds, because they always thinking about how to reduce this recovery time, make it smaller. Always, if you will work with professionals, non-professionals, all investors, all customers will be very worried about when you in the drawdown. So you need always keep in mind this metric and maximize it. I mean, minimize to make it smaller as possible. Profit factor, expectancy, very good metrics, maximum favorable excursion and adverse excursions. Such metrics can give you understanding, is your open positions and closed positions events efficient or not? And this metrics gives you understanding what is the efficiency of taking the profit or eliminating the losses. And also you can consider a ratio between take profit and stop loss. Is also, if you have bigger take profit, it's better, but it's not necessary. Sometimes you can see the very good strategies with small take profit and big stop losses. And specifically for crypto, sometimes it's happened, and most of our strategies have big stop losses because market is very volatile. Sometimes there are a lot of fake movements, noise movements, and in this case, if you will have small stop loss, you will have big chances to be hit by the market. Okay, the other important thing is to calculate the correlation between strategies. So before we speak about the correlation between separate trades, but when you have a portfolio with different strategies, definitely you need to calculate the correlation between them. And sometimes it's actually, it was some interesting events. Sometimes we discover strategies that are nested. We called it nested strategies. You see this strategy S1.7 and this S1.10. They have from one side correlation 89%, but from the other side 39%. So absolutely different numbers. What it means? It means that one strategy have some trades, and the other strategy have bigger amount of trades, and trades of first strategy all covered by second strategy. Also, sometimes first strategy use, for example, trades with a short period of time, and the second strategy have prolonged positions. So this is actually interesting thing, and based on our research, we realized that it's better to also keep nested strategies because they working absolutely different way. You see right now metrics of the correlation in our current portfolio, but it pretty well cleaned with strategies with high correlation, and definitely I can also recommend it to you. So if you build in portfolios, you absolutely need to calculate correlation. So you can make it easy in very easy way. You can just build P&L curve and calculate correlation between them. The second way I like better. You can calculate the percentage of time. What is the same? You have same positions like long position for first strategy and for second strategy, and this percentage of time you can add to this matrix. So it will be not correlation, but it will be works in the similar way. And from our experiences, it works better. This is an example of trades of our portfolio. So don't worry if your strategy, so you know, if you're engaged in trading, you know that not all your trades will be profitable. If you trade with somebody and they have only profitable trades, be careful, please, because it looks like martingale. Nobody can predict the future with a high probability. So that's why it's normal when your strategy will have losses, will have drawdowns, it's okay. And you should just have a diversification to reduce these events. Here you can see actually not very good situation for the portfolio, because the portfolio are more adapted to the high volatility, to the strong trends that continue with long continuation. And as you can see, some strategies open position here because it was movement. Some strategies open position here because it's begun some correction, some drawdown, and other strategy open position additional. But after the movement, the other strategy decided to make trade in the continuation of this movement. And this is an issue of regularization, of generalization that I told before about classical machine learning approach, that your strategies will be learned based on some events that gives you high profitability. So that's why you need to build strategies. This is actually what your results you can see. This is after such cleaning and after the improvements. But in general, if you will not consider such protection steps, in this case, you will have an issue because you will generate strategies that are only working on the high volatility market. But here is no volatility, here is low volatility, but as you can see, there are a lot of profitable trades. Here profitable trades, here profitable trades. Yes, this is two losses trades, but here is as well profitable trades. This is profitable trade. And even on the flat market, on the range market, our portfolio demonstrates results slightly better than zero, a little bit better than zero, like plus 0.2%. On this event. The other interesting thing, if you use alpha mining approach, so you will discover strategies that are used by other participants. This is absolutely interesting thing, because everybody knows history, and everybody not everybody, but a lot of algorithmic trading companies try to discover new strategies. Somebody right now checking strategies in manual way, somebody have alpha mining technique and generate different strategies right now. But a lot of them can create strategies that are very similar to each other. And for example, we sometimes see such events. So this is vertical yellow line. This is event when we have signal occurred, we open position. And then in 20 seconds, this is time frame 5 seconds. One candlestick is 5 second interval. And we see that high volatile event occurs in 20 seconds after the after we opened position. And the interesting thing is that typically, if you use LFT, low frequency trading, you hold some level. So you have a signal by this price, and you would like to open position by this level. And if price go up and you would like to open long position, probably you will wait. It's depending on your strategy. Some strategies would like to open again and again. Some strategies will wait. And for example, for our experience, We actually have a additional service. Our colleagues just finished it, I think 1 week ago. And this service can help to understand what is the execution algorithm is better. So what is better, to execute all amount immediately or to wait better price? If wait better price, how long wait for this price? If we close in position as well, close it immediately or wait for some period of time. And we actually use an algorithm to wait and to open position by original price or better. And see, in this example, we opened position here. It was small amount of money that we invested in this trade, and we opened position very easy. But then price go up, then go down, and it looks like that some hedge fund, that some big company waiting for this price and picking up again and again, and you see a lot of spikes, and exactly on the level that our strategies open signal. And if you're using alpha mining, so probably you will also face this issue. No, it's not issue, but this is interesting approach that you will see that somebody else using your system as well. The other interesting thing about alpha mining, that using our technology, or you can use with your alpha mining system if you have so. So you can even digitize other strategies. I mean, for example, right now we cooperating with one French guy. He is trader, and he have absolutely great experience with trading on financial markets, on futures market, and on commodities. And he have idea how to trade, but his strategy is very difficult. So even when he explains the strategy, it took something like 2-3 hours, and this is just initial explanation. If the strategy to code, I think it will be spent even not 3-4 months. It will be spent maybe a year or even more, because there are a lot of specifics on it. So what we have an idea with him. So he will just bring the labeling based on his strategy, and then we will use alpha mining to recreate these strategies, to create a synthetic copy, or to perform reverse engineering. And this is one additional interesting feature that we can do, or you can do with this approach, that you can, for example, you have traders that would like to automate strategies. With alpha mining, you can do it. For example, you can make labeling based on uptrends, downtrends, or some specific or other specifics, and then you can as well generate strategies based on this labeling to make predictions and to generate strategies as a result. This is an example how our alpha mining algorithm works. And here, actually, it's not good experiment, because here we have top accuracy, something like 53% top. It's very, very low accuracy. Typically, we have for our live portfolios, we have accuracy from 57% to maximum 64%. We can't hit this barrier, this limit yet. Probably in the next versions of our system, it will be possible, but right now we have a maximum best accuracy 64%. And using alpha mining approach, you see, we can calculate accuracy in sample and out of sample using Perry-Kaufman approach like Zebra to split time series on small pieces. And then we can evaluate, is this experiment good enough? What is the average overfitting? So the difference between accuracy in sample and difference with accuracy out of sample, we called it overfitting ratio. So you can see the different overfittings for this experiment. And you can calculate average overfitting for all your pre-calculated data, and then decide, is it your approach good enough or not? And if you're using labeling, to maybe it's a reason to switch to some other labeling. Okay, So that's all for the beginning. I mean, for the today's lecture, and I now switch into the conclusions and to takeaways. I would like to say that please send feedback. Please ask questions after this slide. I will be happy to answer you. And also, I have in mind to organize other meetings about algorithmic trading, to go a little bit deeper in other aspects of AlphaCube or about other aspects of algorithmic trading industry. If you have some ideas to organize as well, please tell guys from Data Science UA or me, and I will be happy to also speak about other topics on the next events. Here actually key takeaways that it's for you, for all of you, for all audience. And also, I think when I wrote this slide, I thought about my own conclusions. What I think we're doing wrong in our project, what should be improved, and what is the main goals of what we are doing. And here is the first. I think you definitely should be careful with regularization, and you need to reduce this generalized strategies. So, and how you can make it, you can adapt to different market. So you can create different strategies for different markets. As well, you can create different strategies for different volatility. Because if you're using the same strategies for all the markets, it's not good. Sure, your strategies will have some volatility or trend filters. This is only possible way to survive. So if your strategies have such filters, it could be obvious or not obvious. So maybe you generated some filters. Maybe such filters looks like not trend filters, but actually they can perform such filtering feature. So this is absolutely important to have such trend filters, volatility filters, because you can trade absolutely identical to any market configuration. Always keep in mind overfitting, because it's the main problem and main enemy for all algo traders. I think all my last 12 years overfitting issue, and I performed different experiments and researches regarding how to overfitting could be eliminated. So I think you always need to keep it in mind. Also, if you will just calculate the best portfolio for current moment, it's not enough. You should consider some ideas to rebalance your portfolio, to adapt to volatility, or to regenerate your strategies. So minimum you need to update it each 3 months, is better update it each month, maybe even each week. It's depending on your technological possibilities, but it should be updated, because market always changing, and you need to be connected with these changes, and you need to adjust everything to it. And then the next conclusion is you should be fast. So if you spending a lot of time on creating strategies, on testing them, on going to the live, debugging, bug fixing, your team is not flexible, you're not flexible, so you need to fix it as soon as possible. So if you go into algorithmic trading, even for LFT, low frequency trading, you should be fast. Make fast calculations, adaptations, launch strategies fast, and update portfolios as well fast. I'm not believe in human trading, consistent human trading. I know a lot of really genius traders, one genius trader in our team, and actually, but to be honest, I can't imagine how it's possible to do unsuccessful trading for a long period of time, and each year close successfully, because it's very difficult to, if you scalper, it's extremely difficult to adapt to always to the new market. If you're a long time trader, you hold in positions for a long period of time. Also, you will have an issue with prediction of such big trends. So drawdowns will be probably big. So to be honest, my personal opinion that all what you do in case of trading and investments, all should be automated. And don't be a victim of human factor, of some laziness, forgetfulness of your team. So because you can make some great strategy, so make some great trade, but in 2-3 months, you can forget how you did it. And even if you wrote and describe how you did it, probably you will understand it a little bit from other side, because our brain is very flexible. We are adapting all the time, and based on our information that we will have after the 3 months, we can make a little bit slightly different conclusions and make slightly different trades. So I actually, to be honest, believe in only in fully automated trading. And if you can automate it, please make it full. All the steps should be automated. And as a big issue in the algorithmic trading sphere, always. So you will have always issue with a lack of funds, lack of customers, drawdowns. So it's actually a very difficult way. And please consider seriously about should you go into this place, because it's very difficult and long way. It's not possible to make profits stable for the beginning. For the beginner, you should become professional. You should understand all toolkits, all libraries, and all what you're doing to receive stable results. And always you will have issue with time, with money. You need to be efficient as possible, and you see it like chess game. So you need to make one move, but in this one move should be best. And you will have all the time this lack of, actually it's not in algorithmic, it's not only in algorithmic trading, in businesses as well, probably in most cases but I think in algorithmic trading is most contrastful. So please don't deep dive in the mathematical models, machine learning models. Keep the helicopter view. Just make some pause, understand where are you, and define the main goals and go to them. So this is extremely important. And that I told, additional materials, absolutely the best advances in financial machine learning by DePrada, machine learning deploying computer algorithms to conquer the markets by Chan, the book about algorithmic trading and about trading systems by Perry Kaufman that I mentioned a few times, and I mentioned it about in-sample and out-of-sample technique. It in details described. If you need some inspiration and to know how it was algorithmic trading starts and what is the history of algorithmic trading, I definitely can recommend the book Once by Scott Patterson. And one interesting book, it's not very qualitative book. It's have a lot of gaps, I think. But what is this book is interesting because this book describes a little bit alpha mining approach. They called it alpha generation. So that's why I also put it here. So in this book you can find the whole chapter about alpha mining. If you would like to go a little bit deeper, I can recommend you Financial Markets course from Robert Schiller, but it's not about algorithmic trading, it's about financial markets, about some fundamentals. I definitely recommend you see it's like for developers. You can't write a really good code if you don't understand how your in general works your compiler, or how in general works your operating system. You need to know what is the memory, what is the hard drive, what is the CPU. You need to understand briefly how it works. The same for financial markets. If you trade on them, you need to understand the background of it. So that's why I recommend Robert Schiller course. He is a Nobel Prize winner. He is not easy to listen, but the things that he described is pretty simple. So I definitely recommend it. Also, one great course by Columbia University, Financial Engineering and Risk Management. This is course great. This is Columbia University. Actually, as this university explains, from my point of view, that market is efficient. And it's like MIT. They also explains the market is efficient. But for example, Robert Schiller, he told that actually market is not efficient because he works with some hedge funds and he knows that market is not efficient. So this course, Financial Engineering and Risk Management, this is interesting course, but this is classical, theoretical course based on market is efficient. So this course explains mathematical background of the financial instruments, but it should be also considered, and you also should know these fundamentals. And few interesting discoveries from my side. Recently, I discovered events from Quant Insti company and from Princeton University. They organize this Princeton FinTech events. And I can say that for the last year, I participate in different events, but these two organizations that are hosting the events, they are absolutely great. This is not advertisement. This is my just personal recommendation. You can follow them and look for some events. They're really good. That's all. Thank you, guys. You can reach me out in the LinkedIn, Facebook, Telegram, email. So please let me know if you have some ideas of collaboration, some questions. Maybe we can help you with what we have. Somehow we can help you. And actually, we are small startup. We have only 9 guys in our team, so we are really flexible, and we are looking for new communications, new partnership, and we're looking for the new possible ideas. So let's keep in touch, and I'm listening for your questions if you have so.
Thank you very much, Bogdan, for event. It was very interesting. The presentation is great. So now we'll have a Q&A session. So guys, prepare your questions. You can ask it here in live, or you can send it in chat here. So don't be shy. It's a nice opportunity to talk with speaker in real life. So who is the first?
Thank you, Bogdan. Very interesting.
You're welcome.
Guys, so any questions?